Hello, I'm Adam Harter, Chief Investment Officer, Financial Enhancement Group, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you so much for clicking on this market Carver and giving us a few minutes of your time, where we're going to cover some of the things that we are covered in this week's investment allocation meeting. And no, just answering the number one question right off the bat, Andrew and I did not coordinate colors. That's not something we did here. So you're welcome for that little accident. So. And Andrew does want to know who wore it better, but I'm not even going to apply for that. It's definitely him. So.
Thanks.
The three topics we got for you this week. Well, we're going to talk about banks, seemingly a topic that is just with us for some time being. So just want to update you on that and where we may be going from here. AI, something gaining traction and something we saw a lot of in earnings reports. Andrew will cover that and give us an update on this dynamic between your average stock and what we see happening in the indices. So let's start off with the banks and tightening lending standards. So a couple of things are happening here. And before I explain the chart, I'll just say just generally one thing that's happening following Silicon Valley Bank is that there has been a slow, steady stream of deposits coming out of the banking system. Actually, of course, it happened before Silicon Valley Bank, but it's happening even more rapidly. And it's just simply from the fact that banks never really wanted to chase or pay depositors a healthy interest rate. And so investors who have those deposits have been looking for other things like money markets to invest in. So as a result, the banks have had to replace those deposits, which are very inexpensive for them, really cheap funding, with more expensive sources of funding. So their ability to lend has been impaired, at least at the regional bank level and your smaller banks. Now, your larger banks actually coincidentally have even gotten in better shape. So they're not quite so impaired, but a lot of lending at the local economy level and the things and the types of businesses that are formed and expand happen at your smaller and regional bank, which have the relationships for your kind of boots on the ground economy. So that sets the stage for really this survey that we're sharing results of. The blue line is the response of bank lending officers and measuring how many of them are tightening their standards. And we have seen a rapid rise, as you would expect, right? If their deposits are fleeing and they're having to replace those with expensive sources of fundings, of course, they are going to be a lot more selective about who they can lend to. So that does have some implications for certain segments of the economy. Certainly, if it stayed here for too long, that could be a drag and be something that maybe tips us into a slower economy or maybe even into what ultimately provides a recession. We don't know on that. But one thing we can see over time is that when we see periods of banks tightening their belts and tightening lending, what we see are what known as high yield spreads rise. And all that means is that investors demand more and more interest rates from your riskier bonds. So they would just rather have your U.S. treasuries or very safe corporations as opposed to those which might have a little bit more impaired credit. And so right now, that is one thing that we have shifted portfolios even further to be further away from these high yield entities, because if we're fine taking those risks over time, but we want to be properly compensated. And history tells us at this point in time that there could be some further damage. And so we want to wait until we get higher interest rates to enter those. So now shifting over to AI, Andrew, I thought this was really interesting. If you could share with everybody what you found looking at earnings calls for the first quarter.
Yeah, so AI is something we're seeing a lot in the news. And just a reminder, AI stands for artificial intelligence. What got this conversation started was last year, the kind of the invention, the creation, the launch, whatever word you want to use, of ChatGPT. It's probably something if you maybe have heard your kids talk about, or grandkids, or you yourself have played with ChatGPT, this artificial intelligence, where it can answer questions, it can write papers, students are using it for homework, but we're seeing more and more companies start to discuss and adapt to using artificial intelligence within their businesses. In fact, one study that was done by Goldman Sachs, where they looked at all the different conference calls done after Q1 earnings season, and found that a lot of companies were talking about artificial intelligence on their call. You can see here over 70% of communication companies, over 60% of tech stocks, all the way down to even utility companies, materials, energy, across all the different sectors, we're starting to see AI being discussed. This isn't the first time we've seen something that's kind of trendy, something, a big popular topic, really kind of flood into the investment world and start getting discussed and mentioned. Remember a couple years ago, blockchain and crypto was all the rage. And that was a very popular topic about how everyone was trying to add blockchain to their businesses until crypto crashed. If you go even further back, go to the .com era, where all you had really to do was add .com to your name, and companies were seeing their stock prices skyrocket high until that trend kind of faded, and they realized that you needed a little bit more than just a name change in a website to really generate profit. So right now it seems to be AI. We'll see. This is likely something that could be with us for a while as companies begin to adapt this new type of technology. But what the implications are for the portfolio is we're really seeing a lot of these tech stocks, especially the ones that are more sensitive to AI, are really what have been driving the market higher. Specifically, stocks like NVIDIA, Microsoft, some of the other big tech names, Micron. And so what we're seeing, and we've been discussing in our allocation meetings, we've mentioned it several times here on the market Carver, is the mega caps really have been leading. It's essentially just been about 7 stocks that account for the lion's share of the year-to-date gains. And it's a group that we've talked about before, the FAAMG group: Facebook, Amazon, Apple, Microsoft, Google. And that's going to be our next chart, really showing the spread in performance of just these handful of stocks relative to what the rest of the market's doing. So here on this chart, you can see we have the broad S&P 500. We have an equal weighting of those stocks. Again, Facebook, Amazon, Apple, Microsoft, and Google. And then we actually have an equal weighting of all the S&P 500 stocks. As a reminder, the S&P is market cap weighted. So the larger the company, the higher the weighting. So those stocks like Apple, Microsoft, Google, Tesla, Berkshire Hathaway have a higher weighting in the S&P 500. If we just assign everyone the same share of the index, that gives us our equal weighting S&P. And so as we can see on the far right side, the FAANG group has really been moving higher and been very strong since March. Meanwhile, the average stock, looking at the equal weighted version, can't even get above its long-term moving average and has really been making a series of lower highs. This tells us that under the surface, we're not seeing a lot of big strength, not necessarily a lot of weakness, but we're not seeing a lot of strength from the average stock. This is something we've seen happen in the market numerous times, and it can be with us for an unknown amount of time. We saw it basically in Q4 of 2021. It lasted for months. Other times it dries up and we see the market respond either positively or negatively pretty quick. So we are seeing this kind of bifurcation within the market where it's just kind of these AI stocks, again, like stocks like Microsoft, that have done really, really well and helped move the S&P higher. But when we look across the whole landscape of the investment of the S&P large cap, and it's even worse when we start looking at smaller mid cap stocks, aren't being able to hold up as well. That's a little bit concerning to us and something that has on our radar, and we're discussing every single week and how this will impact the broad market, but also the implications for the portfolios and models that we manage here at Financial Enhancement Group.
Yep, absolutely. That's just the theme of the year, right? Every year seems to have a thing or two, and this has been one that's been a surprise, and it's been with us for some time. So, and I have no doubt you'll keep us up to date on that. So thank you, Andrew, and thank you to all of you for giving us this time for the Market Carver. Don't, as always, forget that you can give us a call, 800-928-4001, if there's any way we can be of help. And of course, you can schedule, if we don't have the pleasure of working with you yet, schedule your next steps meeting. Won't cost you anything, and probably walk away from there with some things that you can implement, whether or not we choose to work together. So thanks again, and have a great weekend.